And hello and welcome to the first episode of Startup Caps, your eye on startup capital movements in Africa, where over the next couple of weeks we'll be unpacking just exactly where the capital is going when it comes to new ventures on the African continent. Now, to get us going, let's take a look at where exactly Africa stands in the past year's venture capital movements.
In 2023, the global venture capital market witnessed a significant downturn, contracting by 38% year-on-year to a total of $285 billion invested worldwide, a stark decrease from the highs of 2021. North America continued to lead with over $144 billion, representing 51% of the global total. However, this year also saw artificial intelligence as a standout sector, capturing a significant portion of venture capital investments. Turning our focus to Africa, the venture capital landscape has also felt the global chill. Despite this, the continent saw strategic investments totaling $3.6 billion across various sectors, with Nigeria, South Africa, Kenya, and Egypt, Africa's big four, dominating the scene. Notably, Nigeria retained its lead with 19% of the deal volume, closely followed by South Africa at 18% of deals and Kenya at 14%. Here's a look at the investment activity by sector. The financial sector led in both deal volume and value, with 23% of deal volume and 48% of the total deal value. The sector attracted $1.7 billion in 2023, a decrease from $2.2 billion in 2022. Next up, information technology. This sector followed closely, being involved in numerous innovative ventures, including SaaS, affordable internet, and cybersecurity services. It remained vibrant despite a slight dip in the number of deals from the previous years. In third position, industrial received 12% of the venture dollars allocated to Africa in 2023, showing an increasing interest due to tech-enabled solutions to traditional industry. And in fourth position, consumer, discretionary, and utilities each received 9% of the venture dollars. This includes investment in diverse areas from e-commerce to clean and climate tech within the utilities sector. Now, let's take a look at where the investments came from. In first position, the United States of America. Investors from the US were involved in 233 deals, representing the largest international contribution for Africa's venture capital scene in 2023. In second position, the United Kingdom, France, and the Netherlands. UK-based investors participated in 50 deals, while those from France and the Netherlands were involved in 40 and 20 deals respectively. South Africa, Nigeria, and Egypt in third position. Within Africa, South African investors led with participation in 89 deals, followed by Nigeria and Egypt with 46 and 22 deals respectively. Now, let's take a look at the gender lens. Gender lens in venture capital reveals a slow but positive shift. Women-led startups received 16% of the total venture capital, marking a gradual increase in funding equity. Furthermore, gender-diverse teams continue to attract more investment, reflecting a broader trend towards inclusivity in the startup ecosystem.
And now that we've seen just exactly where we are, we thought we'd invite those calling the investment shots for an overview of the investment landscape. My first conversation is with David van Dijk, team leader for Boost Africa at the European Investment Bank, and Caller Einer, managing partner at Ventures Platform. So, David, when we look at investments coming into the continent, within the wider context of global investments, it's still but marginal, firstly, and also it's still predominantly coming from outside Africa. So my first question is why?
Yes. Well, I think it's good to understand that the ecosystem is still very nascent, right? Which means that there are not that many local investors just yet. They have been growing in number, more deals are being done locally, but much more need to happen. I think another interesting statistic actually is that with sort of the moving away of some of the foreign capital, the number of local African investors has actually now is now larger than the number of foreign investors. So the amount is still bigger overseas, but the number of actively investing investors has been growing substantially.
And Kola, I'd like to bring this question to you then, is what can we do to make sure that we get more investors locally, more homegrown African investment houses, from VCs all the way through to private equity?
Sure, thanks. Great question. I think that is something that is top of mind across the continent today, because you have a multi-stakeholder requirement to really grow local investment flows. So one, governments have a role to play to ease sort of regulations, ensure that the environments have incentives for local capital sources to be unlocked here. You also have DFIs also play a critical role, and we've seen that grow with DFIs catalyzing more local fund managers across the continent. You know, when we saw the pullback of foreign capital in 2020, starting from 2022, it wasn't as terrible as some had predicted, because you had a significant number of local investors that had dry gunpowder to sort of fill in that gap. And so I think we're already seeing progress in the right direction, but there's so much more that needs to be done to ensure that the local investing ecosystem is quite buoyant.
Now, I can imagine I want to come to you just now. I can imagine one of the things that investors are looking at, whether locally or foreign investors, is just the fragmentation that we have in terms of the market. How do you approach this?
Sure. No, obviously Africa is a very fragmented market, which makes it very hard to operate on a Pan-African scale. At the same time, actually, you know, where friction is, innovation happens, right? So there's very good examples of innovative companies that actually are very able to address these more fragmented markets. So good examples are digital platforms, think Uber, Booking, who are able to, you know, create a one point of entry, if you will. And an African example is probably Flutterwave, who's been able to, you know, combine very fragmented payment gateways, etc., and actually thrive in that fragmented market.
I hear you nodding.
Yeah, you know, I like to start by saying Africa is not a country. We've had that being said before, but that's really at the heart of the challenge here. Is you'll be surprised how fundamentally different consumer behavior, culture is within, say, from Nigeria and Ghana, for instance. But there are some strategies we've seen being effective in sort of expansion beyond one primary market. I think, first off, I like to highlight there's certain regions where you have inherent advantages. Say, take for instance the Francophone market, where you've got a common regulator, you've got a common currency, pegged currency as well. It's often easier for certain business models to scale in those regional blocks. And the second trend we've seen is effectively where certain business models are more akin to being more scalable, especially where there's minimal boots on the ground requirements for those business models. And I think the third strategy that we've seen across our portfolio is where companies grow to a certain level of penetration in their local markets and are able to expand inorganically by acquiring a local entity with local team members that understand the culture, the nuance, the regulatory requirements in that local market. And so look, this is something that needs to be considered very thoughtfully, because as we often say, Africa is not a country.
Now, I want to talk about where the capital is actually going to, but from a founder perspective. There's this notion that is floating that, let's put it this way, investment, certain founders, like an elite club, where certain founders are more prone to be able to attract capital through relationships and networks and access by virtue of the schools they went to, by virtue of the people they hang around with. Would you agree with that notion?
I would say if you look at markets like Nigeria, for instance, we have actually seen a relatively balanced distribution where you have some of the leading founders, say the founder of Flutterwave, the founder of Paystack, went to local universities, were educated locally, worked in the financial services industry locally. But then you also have the diasporan founders that went to Ivy universities and whatnot. And so I think you have that tendency less in certain markets and probably more pronounced in other markets. What we tend to see consistent across venture capital, and not just in Nigeria or Africa and across the world is really that it's a function of your network. So that network could very well be your corporate experience or the universities you went to, because after all, people love to do business with people they know. And as we often say, we receive inbound pitches on our website, but a warm introduction is 10 times more effective than a random pitch. And so I think this is consistent with what you'll expect.
David, is this something that you look at in terms of investing? Who you're actually investing in? And if so, what are the criteria?
So on a general note, I think that we need to do much more to make sure this is inclusive, meaning that every entrepreneur on the continent should have a fighting chance to start and grow their company. Now, so for me personally, really I couldn't care less what gender or race or education someone brings. It's purely what is the proposition on the table? Do I understand it? Do I believe in this founder? That sort of helps me make investment decisions.
Okay, brilliant. Now, I also want to talk about Africa's demographics. That's something that when we're hearing investors talk, it seems to be what we're banking on. The demographics, growing population, young population. How important is it, and what are the biggest opportunities that you see within that?
Brilliant question. Look, I think the African demographic promise is an entry point, but it's not the end of the story. I think the real challenge in Africa, when you consider the fact that less than 0.5% of our population lives above $50 a day across the continent, you realize that what you have is a vast population of effectively non-consumers or under-consumers. And so the real opportunity here is to invest in innovations and startups that are able to convert those non-consumers into consumers. Now, it doesn't matter if you have 1 billion of them or if you have 20 billion of them. If they're not able to consume, then you don't have sort of the venture, the developmental opportunity that we so need. And so I think what we need to get right as an ecosystem of investors and founders is to ensure that we're building the right kinds of businesses that are able to sort of bridge the gap between consumption and non-consumption.
And I wonder if this is linked to the lack of exits, because we can't ignore that. When we look across sectors, and that's what we're going to be doing throughout this show, every time I look at the data, it's like, yeah, there's been X amount of deals, yet very few exits. What would you say is the biggest reason why we're not seeing the amount, or let's say the exits that would have been desired from any other market?
Right. Cola?
Look, I would say there have been exits. There have been some public ones, there have been some private ones. I think part of the challenge is a lack of information. People on this continent tend to want to be slightly more private with their transactions, but there's no gainsaying that we do need to see an acceleration in the recycling of capital, and that's really what helps to catalyze more flows, whether it be local capital or foreign capital. In 2020, when the Paystack exit happened by Stripe, you saw an overflowing of interest of private individuals, corporates, and I would dare say that probably helped to accelerate the spike we saw leading to, in 2022, over $5 billion flowing into the continent. And so, look, I think the matter of exits is top of mind. There's a lot of work going on across the continent at various exchanges to sort of ensure that companies can list locally. There's many focus groups across the continent looking at this conversation. I'm quite optimistic. I suspect that we would have news of exits more so in the coming months.
Maybe to build on that, it is vitally important.
Yeah.
Because it has a very important sort of signaling effect to show that there's local success stories. And also very important is that what you see with the Paystack example that Kola mentions is that most of the investors who, let's say, are successful with an exit, and most of the founders successful, who then turn around and fund the next generation. And the best investor is someone who's actually been able to grow and exit a digital company. So it's vitally important for the ecosystem that investment capital is returned, but also to have these type of entrepreneurs involved in the investment process.
While you aren't quite seeing sort of full exits at the scale you'd like to see. What has actually increased recently is secondary exits, where early stage investors are able to exit their positions, recycle capital to later stage investors or private equity groups. And I think that must be encouraged, and because it helps to keep the ecosystem active. But definitely success, as they say, begets more success. And so we desperately need those large exits. Yeah.
And that's where we'll leave it. Great sentence. Success begets more success. Thank you so much to the both of you for joining us today. Really a pleasure talking to you. And now that we've heard from the investors, painting a landscape of the investment landscape on the African continent, let's hear from founders. Evelyn Kayingu, co-founder of Lupia, and Melvin Lubega, co-founder of Go1 and partner at Briga. And Evelyn, I actually want to start with you. What was it like raising for the first time? What were some of the challenges that you encountered?
I mean, if you ask an entrepreneur what challenges, there are going to be so many, right? But I mean, specifically narrowing it down was basically one, not having immovable assets, which basically financial institutions need for you to be able to leverage financing or any form of capital instruments that they might have. And circling back as well, you find that you don't meet a lot of requirements as a small entity. So your revenue numbers have to be high enough. And so you're too small as an entity as well to be able to leverage financing from formalized institutions. And so a lot of challenges put together. And as an entity, you realize that perhaps they need more capacity in terms of what the team structure looks like to be able to leverage different functions of the business. So they want to make sure that your underwriting standards are very clear. They want to make sure you have a different size of loan book to be able to leverage additional capital. So I'm from a finance entity. And so they wanted to make sure that we had a book sizable enough to be able to cover any form of default that would come from leveraging financing from a formal institution.
Okay, Melvin, I'd like to ask you the same question actually. What was it like for you? I mean, you're noted as having made a very significant raise. What was it like actually getting that done?
I think different stages have different complexities. I think when we began our journey almost now 8 years ago, the reality is you'd speak to 100 people to get 2 checks. I think as you get more mature, to Evelyn's point, as you mature, you may speak to, 100 people and get even more than 100 checks because the reality is more interest in your business. I think for us very early on, the biggest challenge was to understand who are the right partners for us. I think not all money is the same, and not every investor understands or gets it. I think not every investor has been an entrepreneur or has been on that journey.
Have you ever had the experience of not having the right partner?
So almost not having the right partner. I think I'm very grateful for the partners I've had on my journey, but particularly investment partners. I think there have been instances where there was a high net worth who was very interested in the business, was keen to help us expand into Europe. At the time we weren't there. And met with him, and it was a very good conversation. But the actual term sheet we received was very different from the conversation. Lots of terms that were a bit too against us as founders and as a business. And so we said no to the term sheet, and then he tried to sue us because we didn't accept his term sheet. And I think for me, it's good that happened then rather than 3 years into the investment period, because you won't necessarily know how someone shows up. And so something I've come to appreciate is the importance of legals, also the importance of speaking to other investee companies of that investor to understand how they treat you when you're doing well, and when you're not doing well, how do they treat you then as well?
Yeah. And Evelyn, coming back to you actually, because when we're talking about partnerships and finding the right strategic investor, what do you look for?
I mean, it's 2 things. On our end, it's just everyone who would resonate with the same values that we have. Our business is structured a little bit different. It's a couple. So my husband and I started this business together. And so very easily in every room that we get into is the biggest question asked is, are you going to work well together? And can this function as a couple? And so firstly, we want to make sure that we can resolve that and ensure that we give them the confidence to be able to do it. And so we've seen ourselves aligning very easily with impact funders. We've seen ourselves aligning very easily with our initial pre-seed investor. It was designed and built by a couple. And so it was very easy for them to resonate with us. And from then, we've been able to grow very quickly. And then just second thing for us would just be around how quickly we can demonstrate the traction that we have to be able to ensure that we are aligned with that particular investor. So We want to grow quite aggressively and quickly. Most investors are quite skeptical around how quickly we can move into additional markets, how quickly we want to run with certain projects. And so that alignment is very important for us to ensure that we align with our investors over those two core values or intentions that we ensure we want to place in the business.
Now, the other aspect of raising is, of course, the valuation. And I think that's something that a lot of businesses struggle with. Now, Melvin, you play on both sides. You're a founder and an investor. How do you look at company valuations, and what are some of the factors that you feel influence this?
I think ultimately it's about supply and demand. I think as a investor, you don't want to overpay. As an entrepreneur, you hope everyone overpays. And I think it's one of those tensions that one has to hold in arm. But ultimately, the person that gives you the highest valuation as an investor isn't necessarily the right investor. I think often people forget that in the process. So for us, it's often about saying, if I as a VC investor, having been an entrepreneur, I want to return funds to my stakeholders, my LPs, my partners. And so from that perspective, I can't overpay for a business, otherwise I'm able to return the money back to expectation versus the risk we take on. And so the question is almost say, how do we come into a reasonable valuation for the founder and the investor such that we can come together and grow the business together? I think the worst thing you can do is raise that valuation too high and then run the risk of running a down round in your next round. And so it's often more, one, what's the market saying, but two, also understanding what is a fair valuation. And that being said, valuations recently have come off from the highs of 2 years ago, but it's always about saying what's the value conversation versus the valuation conversation.
Yeah, and I guess also credibility from that aspect. Evelyn, how have you dealt with building credibility when you were starting out? And what would be your advice to other founders that are on that journey?
I mean, it's really positioning quite well, and there's a number of factors that you try and consider. And in our journey through the hundreds of multiple applications that we made and the feedback that we got from investors, it was really a lot of things around traction, how your revenue numbers are growing, and it was very important to be able to demonstrate how you get quickly to the $1 million annualized revenue to be able to raise quite significant amounts of money. And something that we took inside and ensured that even as we projected our financial model, it was able to demonstrate that. And when you look at the actual financials, they're also showing that month-on-month growth to ensure that we're able to demonstrate just that traction in revenue and how it was coming together. Other things that we've taken into consideration now is fintech multiples as well as EBITDA multiples. This was very crucial in our Series A fundraise. And while it really mattered what size our loan book was in our pre-seeds, it mattered how much revenue we're generating. As the game gets bigger, it's about really positioning and really tracking the fintech multiples in the space and then looking at how you can be evaluated based off of your EBITDA as well.
Now, the other part of credibility, and I'm going to ask this question to the both of you, is that, as Melvin said earlier, the first time you may speak to 100 people and only 2 people write you checks. But as you grow further, you develop your network, your credibility. Now, one of the consequences, or rather the criticism of this effect, is that funding then becomes available to an exclusive circle, where those who have received funding already, who have those networks, tend to find it easier to raise even more. How do you feel about that statement?
I think it's a very true statement, just because my current investors, ideally, we had circled back to them on a number of occasions to really just source that funding and really position ourselves to be an entity that can receive that funding. But then I quickly realized in a lot of feedback that when entities, and having been part of an incubator, having been part of a multiple number of networks, when they made the introduction, it made it very easy to get into the room with the investors, to get a meeting with the investors, to actually present what we had, as opposed to the cold calling, which took a lot of time, and we really were only able to raise very small amounts if we did it individually. But when it came with introductions in the circle, for sure, it was a bigger ticket size and it was faster to get to the table.
Melvin, have you experienced that? And if so, how can we make sure to widen that circle of exclusivity?
I think the one thing about networks is that you're never too many degrees away from someone who's actually got a contact into some venture capital. And so for the key thing for us is, even for us, was like, if you think about an investor, who are the other portfolio companies? Because a startup entrepreneur will definitely take your phone call. And I think if you apply the same sort of effort to actually find an investor, track the investor, contact the investor, so understand why are they invested in, what sectors are they keen about, who are the partners, who are their last portfolio companies, you'll find someone into the organization. I think many entrepreneurs don't put in the effort, to the question, to Evelyn's point, to get the right into a investor, or they even take the time to research. Marvin said to me, "Hi Marvin, you're an investor at Brigger, you're focused on PCC in Africa. The reality is you've invested in these 3 companies. We are like this one, but in this geography. We'd love to chat to you, giving you..." If someone came to me like that, I'll take the meeting. I think everyone just says, "Oh, hey, I'm raising money, let's chat." And I think it's about just being different in how you approach it. That being said, I think with technology and even like social media, the barriers are so low to find someone. From Twitter to Instagram to LinkedIn, people are available. But I think it's also to the point, find the right person to intro you. And I think that is possible by just taking the time to map out the ecosystem.
Yeah, and that's a good point that you put forward. It's almost like you're marketing yourself. It's a business development and a marketing and a positioning, and I would even go as far as saying it's a branding exercise of understanding your target audience and target audience, yeah, your investor, and presenting yourself in a way that resonates with them. Now, it's not just working with investors that requires that, Evelyn. It's also as you start and engage with stakeholders. And I can imagine, particularly with your line of work, that government would be an important one. How has that journey been with you? Have you found that you were welcomed by an enabling environment?
I mean, the ecosystem here in Zambia has significantly changed, and we've seen a lot of support from the government. It's very predictive now to work with the government, so that's a plus. What they've done very well is really introduce a number of sandboxes, especially in the finance space. There's a limitation in around spaces like regulation, what SMEs would actually be needing at particular stages. And so very intentionally, the government is doing that. We actually just came out and exited successfully out of the Securities Exchange sandbox. Bank of Zambia as a regulator has done it. We've got a lot of support from the Ministry of SME and Science and Technology. And by the way, for the first time, we had a Ministry of SME with the current government regime. So just very intentional what the government is doing now and ensuring that we now finally also get the Startup Act in Zambia in place, which they're tirelessly working on to ensure that we can all make a contribution and we can all really put together a startup ecosystem that's thriving in the country. And so right now, there's a lot of support coming in from the government, and it's something that's very commendable at the moment.
Okay. Well, thank you to the both of you. This is unfortunately all we have time for, but it's been a pleasure talking to you, Melvin, and it's been a pleasure talking to you, Evelyn. Thank you so much for joining us today. And this is how we wrap up Startup Caps this week. We'll do it again next week, this time looking into the world of fintech. Now make sure to continue the conversation with us on social media. You'll find us on X, Instagram, Facebook, LinkedIn and TikTok with the handle _StartupCaps using the hashtag StartupCapsAfrica. And of course, you can find out more about this week's episode by visiting our website, www.startupcaps.io.